Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we started talking about 50-day moving averages last week and how they're being broken by a number of shares. And I know you want to flesh that out in some detail this week. So let's start off maybe with what the top 40 looks like and where the 50-day moving average is for that index.
Yeah, we did start discussing this last week, and we're going to just relook at it again. What you've got on the screen at the moment is a chart of the Top 40 index going back to 2010. So we're looking back about 5 years here. And that white line that is on the graph is the 50-day moving average. Now, I like a 50-day moving average because that, to me, is a very good barometer for medium-term momentum. 50 days or 50 trading days is the equivalent of about 2.5 months worth of trading action. So it's a very, very good indicator of your medium-term trend and your medium-term momentum. And as a general rule, I've always found if your 50-day moving average is pointing up on any particular stock, then you generally are fairly safe buying that stock. If it's pointing down, then you rather don't want to be buying it because it's telling you that your momentum is down. And I'm talking specifically from a short-term trading perspective here.
Yeah.
So if you have a look at that graph now, if I put boxes around the areas where the 50-day moving average has gone flat or started to point down, what's quite evident during there's 4 occasions in the last 5 years where it's very prevalent that the 50-day moving average has flattened out or it's begun to turn lower. And you can see that there's definitely heightened volatility during that time. And those periods were very difficult to trade because the market's choppy, it's erratic, there's no particular trend. Now, last week on the show, I said that unless we saw a massive rally in the market very suddenly, there was a strong likelihood that our 50-day moving average was going to start to roll over now on our top 40 index. And in fact, that's what's happened now. Over the past week, our 50-day moving average has just begun to turn slightly southwards. And that then begs the question, are we going into another one of these periods of fairly erratic trade, trendless environment, volatility? And I think, yes, the answer is probably we are, I think. And I think the next couple of months are going to be quite difficult to trade, I would imagine. And what we've seen in the last 2 weeks where this market's come off quite hard is probably just a sign of things to come. And we will probably see ongoing volatility from here.
Well, I know you want to flesh this out, but just maybe a quick comment, because 200-day moving averages are also another, I suppose, staple for technical analysts and market traders. But that is a longer-term chart, isn't it? So,
yeah.
You know, if you're a short-term trader, 50-day moving averages, is that for you a better signifier? Yeah,
for me, the 50-day moving average is more relevant for our style of trading because we generally take positions with a view for a couple of weeks maximum. If you're a longer-term trader, then you would look at your 200-day moving average. But what you'll always find is that your 200-day moving average is much smoother than a 50-day moving average because there's a lot more data that it's working with.
Yeah.
Therefore, the movements in that moving average are much, much slower. The 50-day moving average is nice for our style of trading. As I say, 50 days is around about 2.5 months worth of trading history.
Okay. Now, I know that you want to break down the top 40 into its constituents and see how they are doing, whether they're trading above or below their 50-day moving averages.
Yeah, so what I've got here, we've broken this into 4 separate slides so that you can actually see it more clearly, because to put all 42 shares on one slide would be silly. You wouldn't be able to see the names of the shares. And you'll notice I said 42 shares. There's actually, although it's the top 40 index, there are 42 stocks that make up the index. The reason being that Investec and Investec PLC are duplicated, and then you've also got Mondi Limited and Mondi PLC. So hence you've got 2 additional stocks which make up the top 40 index. But what I've done with this exercise is I've looked at each stock and said, is it above or below its 50-day moving average currently? And then in the second column there, what is the slope of the 50-day moving average? Is it pointing up, is it pointing down, or is it pointing pretty much flat or sideways? And it's quite interesting to do this exercise and actually go through it, because it really breaks down the top 40, and you can actually see, looking at this, just how weak the overall constituents of the top 40 index are. So there's the top 10 shares, and obviously those 10 are by far and away the most significant in our top 40 index. I mean, collectively, and you can see the weightings on the right-hand side of that slide. These 10 stocks make up more than half of the weighted value of the overall top 40 index. But notice there, above or below the 50-day moving average, notice there's actually only one stock in that list that's above its 50-day moving average currently, and that is Richemont. All right. Now, if we go on to the next slide, Then there's the next stocks, number 11 to 20. Again, you can see overwhelmingly that the bulk of those stocks are now trading below their 50-day moving averages. We've got Mondi PLC and Investec PLC trading above their 50-day moving averages. The rest are all below. And then if we go to the next lot, all of those are in the red essentially. So we've got stocks number 21 to 31, all below their 50-day moving averages. And then the last slide, here you've got the last couple of shares in terms of their weightings in the top 40 index. And these stocks really don't make up much in terms of their contribution to the top 40 index. But you can see there's a couple there that are trading above their 50-day moving averages. But in essence, when you start to really break it down, you can say that this market, and specifically this top 40, from a breadth perspective, is not looking very good. Most of those stocks are actually trading below their 50-day moving averages. And if we were to summarize all of that information, then it looks as follows. Only 8 out of the 42 stocks are actually trading above their 50-day moving averages. And of those 8, their collective weighting in the top 40 index is 14% of the index.
So it's not massive.
So it's not massive. So basically telling you that 86% of the top 40's weighting is trading below its 50-day moving average. And then in terms of the stocks with the 50-day moving average pointing up or pointing down, you've got 9 out of 42 with the 50-day moving average pointing up, meaning therefore that there are, 33 stocks that have their 50-day moving averages pointing up. In terms of weighting, that is almost 32% of the top 40 index. And the reason for that big discrepancy is because the part of the stocks that do still have 50-day moving averages pointing up are Richemont and Naspers. Those two collectively make up more than 20% of the top 40's weighting. But it also is telling you that the markets, or those two stocks, have a lot of weight on their shoulders in terms of their ability to hold up the market as things stand. If those two stocks were to start to dribble lower, then it could actually have quite a negative bearing. And in all honesty, when I look at the technicals of both Richemont and Naspers, I'm not exactly excited by either of them. They both look a bit vulnerable.
Okay, so it's one bloody picture all round, essentially.
Yeah, it is. And obviously, after 2 weeks of heavy selling on our market, that's not entirely unexpected. But it certainly, for me, it says to me, this is not just a short-term pullback that's going to go and rally back to new highs. I think that to me, it's saying that the medium-term momentum of the market is actually rolling over, and we need to be careful of getting too excessively bullish now.
Okay, well, now talking about rolling over, and I know we're heading into futures closeout next week, which is going to be quite significant, and you'd like to flesh this out too, because you've got quite a lot staked, essentially, on the June futures closeout this year. Yes,
I do. We've got big options positions which are expiring at this June futures closeout. What I want to look at first, though, is a comparison of the December 2014 futures closeout and compare it to the situation that we have on our hands right now, because there's a lot of similarities, and it's almost like deja vu, what we're seeing now and what we saw in December. So that diagram there is the top 40 index looking at the December futures closeout. And what was very interesting then was that there was a lot of optionality in our market at that stage. And when I say optionality, there were plenty of written put options. Obviously written and bought put options. But the point is that there was a significant number of put option interest at different strike levels as the market went lower. And you can see the value of the put option interest there. And as the market fell lower and lower and lower, so the market moved through all of these put option strike levels. And a writer of a put option, in other words, someone that sells a put option, i.e. is short of a put option, when the market starts to go below the strike price of a put option, you would typically want to sell short that instrument in order to hedge your exposure to that short put position. So in this case, you can see billions and billions of rands worth of top 40 put options that were written on the top 40 at different strike intervals. And as the market went lower, so it actually sucked in more selling and more selling and more selling, because you had all of these derivatives players that needed to sell short futures in order to hedge their written option positions.
Okay.
I know that's quite complicated, but in one sentence, it meant that they had to sell into a falling market in order to hedge themselves. However, what happened on the day before the futures closeout in December was we had a FOMC meeting where it was widely expected that Janet Yellen would come out rather hawkish in terms of her outlook for US interest rates. And she did come out hawkish, but the market had priced that in already. And in fact, there was a positive reaction to that. and it was at that meeting where they took the term considerable time out of the statement, and they replaced it with, they said, we will be patient in terms of how we raise interest rates going forward. And the market said, oh, well, that's still hawkish, but it's not as bad as it could have been. And the market rallied very, very hard on the back of that news. Now, what you see happening on the top 40 that day, which was, now keep in mind, that was the Wednesday night before the futures closeout. The Thursday came along, that was the day of the futures closeout in December. Now, you had this positive overnight news, and you had 2 weeks' worth of futures-related selling that had to now be unwound in a morning before the futures closeout period at 12 o'clock. And on that day, the top 40 rallied 2,000 points into the futures closeout. It's the biggest single up day I've ever seen in my life. It was unbelievable. Now, we're setting ourselves up with quite a similar situation now, potentially.
Okay, so you talked about deja vu. What is it looking like for the June futures closeout?
Yeah, so this is how we positioned now. Now, that's obviously the top 40 index now as it stands right now. This is where all the optionality is on our market right now in terms of where there's written puts. There's not much interest in terms of call options on our market right now at any significant level, but there is put optionality written at all those strike levels that you see there. So 46,000, 45,000, 44,000, 43,500. There's lots of it. You can see that all the different, how many billions of rands worth of put options there are written at the different strike intervals over there. So, and again, why I say it's deja vu is because you've got a very similar backdrop in the sense that next week we've also got an FOMC meeting, and we'll hear from Janet Yellen on Wednesday night, the night before the futures closeout. So there's a possibility that if our market stays weak now, I think that all that put optionality could come into play, and you could find that there's a little bit of derivatives-related selling in our market purely to hedge those written put positions.
Okay.
But if Janet Yellen comes out next week, Wednesday, and tells us something that we already know, which in all likelihood is what she's going to do, she's probably going to say to us, the US economy is strong, and we're looking at potentially raising rates towards the end of the year. Now, we all know that already. That's not going to surprise the market. In my opinion, the market would probably take that as a positive surprise because markets don't like uncertainty. But whatever she says is going to remove the uncertainty. And that could very well spark a rally in the market. And if you've got all this futures-related selling that needs to be unwound, that could then result in a sharp spike upwards in our market.
Okay, so how are we positioned, or how are you positioned rather, because you've got options for both a downturn and a surge?
Yeah, well, look, we would do better if we saw a little bit of a downside in our market, but that's our payoff profile for our option structures as they stand right now. Keep in mind these things expire on the 18th of June, next Thursday. Right now, the market is at 45,800 currently, which means that we're running a mark-to-market profit of almost 17,000 Rand on these options. If the market was to fall another 1,000 or 2,000 points from here, we would really be in the money with this structure. But we're likely to make money irrespective of where it closes out, as long as it doesn't go below 42,000.
So we could see a big bout of selling and then also a potentially big rally. So if things transpire as they did last year.
Yeah, that's the scenario that I'm painting. And obviously it's very difficult to say with what level of confidence do I think this is going to happen. But I think that as a roadmap for me is quite a likely scenario, the way I've just discussed it.
Okay, well, there's lots to look out for. Garth, very quickly, we have to wrap up. What the portfolio is looking like in your upcoming courses.
All right, well, the portfolio is looking good. It's actually up a bit from last week. We had almost 332,000 Rand. Our options position's making money for us, so we've actually made money notwithstanding the fact that the market has been down this week. And then last thing, I've got new courses in July, an Understanding CFDs course on the 16th of July, and a high probability trading course on the 18th of July. Anybody that would like to attend either of those, please email me, garth@traderscorner.co.za, and I'll send you all the details.
Okay, great. Lots to chew over this evening. Garth, we have to leave it there, unfortunately, though. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.